Yeah, good morning. Wait for a few more minutes for John. Uh, we'll probably begin right now. So hope you can see my screen chat now. So to begin with, again, for taking the time out to attend another webinar for a large cap. Today we are going to be talking about overview of the ER&D sector in India. And before we get into the sector itself, let's just look at the overlay of the sector versus say listed space in India. Broadly, there are two kinds of players in the market. Is the one of the IT players who, when it comes to the tier one players, they have a broad range of they offer, whereas in the certain niche who offer specific offerings to clients, and these are companies like KPT, so and there are uh, although which are listed in uh, global at least they, uh, while look at India, it's actually very competitive and very successful in service space. So if you take a company to our regions across the world, there are nobody has this large of like, there are roughly around 83 lakh annual graduates graduating colleges in India. Roughly, of course, the cost of higher employees are also low. And believe and the margins top and you build and you your class even those billing rates are over say 30 in other regions. Uh, Company to scale, uh, you know, they, they have an India strategy because it is kind of imperative for them to scale above a certain size. As you know, like, for example, in the past few years, we've seen companies like say and a lot of these European players who have actually struggled due to certain geopolitical issues, finding it hard to increase their workforce and scale their revenues above a certain of the talent pool available. Therefore, even those companies who are successful parts of Eastern Europe are actually moving to India, and they're scaling up their Indian workforce. We see the importance of geography in the entire services ecosystem. Was done by BTG last. It was a study on the top reasons as to why companies select uh, uh, what we talk to select outdoors when we get to insourcing. Second. Hello? Yeah. Yeah, apologies. Ken, I just understood that there was some technical issue. Uh, Hi, Gopi, can you just probably check if the screen is visible?
Yeah, Athreya, it's now the presentation is visible.
And are you able to hear me as well?
Sorry?
Are you able to hear me?
Yeah, your voice is clear now.
Yeah, sure. Yeah, okay.
Yeah, thank
Thank
you.
you. Thank you. Apologies for that. Um, so I hope everything is visible now. Um, Yeah, so what I was saying was this was a survey which was done by BCG last year, and they were asking their clients why they choose to, or what was their top reason for choosing to outsource certain projects. And you can see that predominantly most clients choose to outsource their projects because of cost optimization. So the top reason for clients choosing to outsource projects is due to lower costs. And if reducing costs is their main problem statement, then becomes the obvious solution because of a 40 to 50% discount discount on costs when compared to other regions. Now, moving on to if you take a look at the services exports in India over the past 24 years, post the turn of the century, you from around $5 billion in 2000, the services exports has jumped to close to above $150 billion at present. Therefore, that's a 30%, a 30x jump. So the beginning of the century saw the rise of the offshore model, and growth rates were significantly high at the turn of the century, which was sometime it was hovering above 40% consistently. Post the global financial crisis, there was a turning point, and global growth stalled between 2013 and 16 as there were like a lot of visa issues and because of the rise of cloud and as a service products. And over the past 10 to 15 years, the IT services sector in India has compounded or grown at around 10%, and the ER&D sector has actually grown at a slightly higher rate of around 13% over the past 15 years. And this is because the penetration levels in the R&D space in the outsourcing of ER&D is much lower. It is only in the mid to high teens, whereas the IT services space is a more mature, the traditional IT services rather is way more mature, and the outsourcing penetration in that area is significantly higher. And these services exports were have been boosted by the rise of global capability centers over the past decade. So, if you look at the chart on the right, that is the share of employees in working in GCCs versus the share of employees working in the overall IT space. And you can see that the GCC mix has significantly increased from 18% to 30% over the past over the past 5 to 7 years. Therefore, the GCCs have become way more aggressive when it comes to India, and interestingly, India actually accounts for over 50% of the world's global capability centers. And GCCs are actually more preferable from an employee point of view because uh, one, they offer higher pay when compared to say an outsourcing company or a consulting company, and of course the brand value is slightly better, the work culture is better, and the job profile itself is much better because they work on core research and engineering projects when compared to the IT services players. Um, yeah, and ER&D roughly contributes to 56% of revenues of these GCCs, and India's exports the of R&D has actually doubled over the past 5 years. So you can see that there is actually a war of talent which is ongoing in India, and which might be not so visible at the moment, but because of the slowdown in the sector. But most people prefer to join as employees prefer to join these global capability centers as that's their first choice. The wages for Indian services players have actually started to slightly inch up, and that is kind of a negative over the longer term. And if you look at the services exports itself, the revenues of the GCCs as part of the services exports. So from $9 billion in 2013, the GCC revenues in India has tripled over the past 10 years to $27 billion. Therefore, you can see that there's been a strong growth, and that has accelerated post COVID. And just last week, there was this news article in the newspapers that Chevron is lining up close to investing $1 billion for their innovation center in India. And it is said that in their first phase, they'll be hiring close to 600 candidates, and probably 3 to 4x of that over the tenure of their investment. And you can also see that Flutter, UK based sports betting company, is also opening a global capability center in India. So these are just a few examples. If you are There are a lot of companies, and every company has started to expand their research and development center in India. And broadly, what's happening is that global companies are shifting their global workforce and moving their bases to India. So they're trying to cut and keep their expenditure or employee expenditure in check, because there's a lot of there's a global macro slowdown, and they're trying to maintain or increase margins at this point in time. So this is kind of a longer term theme as well. And moving on, if looking at just the size of the ER&D market as a whole, so roughly, globally, the all the companies in the world, so they spend close to $1.5 trillion on research and development, out of 50% of which is spent by the top 100 companies in the world. And out of that amount, roughly, only $120 billion is outsourced to players, and is outsourced or offshored to internal development centers or to other services vendors. And only 22 to $25 billion is actually being outsourced to Indian IT companies. So you can see that when compared to traditional IT services, the penetration levels here is very low. It will never get to say the penetration levels of traditional IT services, because research and development is kind of core to a company's existence. Therefore, they are not going to outsource everything and their core IP to third-party vendors, because there's no then the need of the existence of the client itself will be in question at that point in time. But this 22 to 25 billion dollars has potential to improve, and the penetration levels can definitely improve from here. Roughly, 20 to 25% of the R&D spends is outsourced to other countries, and 5 to 6% is outsourced to like IT vendors. um, and if you just look at the global ER&D sourcing itself, so right now it's close to 130, $140 billion globally, and that has been significant. That has been growing at a high single-digit rate over the past decade, and the growth rate has actually accelerated post-COVID. And you can see the jump from $90 billion to $130 billion in 2022, and it's actually increased in 2023 and 2024 to say 140, $145 billion. Therefore, the growth rates have also started accelerating, and it was during COVID that many companies were more accepting of work from home policies or offshoring to other countries, for offshoring their R&D work rather to other countries. Therefore, the acceptance levels of offshoring and third party acceptance levels of other vendors have also increased, leading to this acceleration in growth. And this is India's share in the overall ER&D ER&D space in the world. The market share has from below 30% in 2014, it has jumped to 37%, 38% in FY23. Therefore, the market share of Indian players have also started increasing. Now that you've looked at the market, so who all are part of the market? Take a look at who is part of the market. So the top players are the tier one IT players who have a wide bouquet of offerings. You can see Capgemini is at number one, HCL Tech's at number two, the Accentures, Cognizants, and TCS of the world are also there. Um, you can also see the pure play Indian players which have been highlighted, and these companies like LTTS, Tata Elxsi, KPIT, and Cyient, they are pure play R&D companies, and companies like and they are most of these companies are diversified, and they're specialized in certain verticals, whereas KPIT specializes only in the auto vertical. Therefore, uh, it is not like the tier one IT players or the legacy IT players do not have a position. They're not present in this market, but it's just that we don't the split. They do not split their ER&D revenues out, but they are actually significant players in this market as well. But we spoken about the size of the market, but what is actually ER&D, or engineering, research, and development? So you can broadly classify it into three different verticals. One is let's begin with the traditional mechanical engineering work. So broadly, it's hardware design and development, which encompasses design and development of mechanical systems, including, say, selecting the components, product design, fixture design, building prototypes, doing feasibility studies, reverse engineering, and say even cataloging and things like that. So broadly, it's hardware design and development, and that was traditionally the legacy, ER&D or mechanical engineering work. Uh, however, over the past few years, even embedded engineering has really started gaining traction, and these companies have started doing well. So, embedded engineering is nothing but kind of writing mainframe software, similar to how an OS or like Microsoft Windows controls computers. Embedded software are tools which enable the functioning of machines. So they take the PCB and prototypes made by the hardware engineers and design and write code to control and utilize the hardware components. Therefore, as smart devices become more common and as they gain traction, embedded engineering skills will or embedded engineering will also start. Will grow in line with smart devices. So this is generally popular in, say, consumer electronics, medical devices, and in aviation. Because the software has to be tailored to meet the needs of the hardware it runs on. As these products are actually the products have to perform in a physical environment, and the environmental factors and things like temperature which affect these products and machines have to be taken note of and have to be solved for. The final part of ER&D is the software design, basically product engineering or platform engineering, and which is which is relatively what you generally think of, which is like building software products, building software platforms, and things like that, which is pretty common. So, and if you take a look at, what all industries do, which need or require this the ER&D kind of work, you can see that it is required. This kind of work is required across industries. So the use cases are far and wide. It is used in, say, automotive, aerospace, consumer electronics, medical devices, semiconductors for designing, custom chips for certain products, and even in telecoms, and even in the telecom space. So the use cases are really far and wide. And if you look at the classification of the spends as well, so roughly the embedded electronics and digital engineering, that is software product development, is equal to each other, and they are about $45 billion each. Uh, and these are the two areas which are actually growing faster than, say, mechanical engineering, and mechanical engineering is around 37 to $40 billion. So you can see what contributes to the 37, I mean, to these different subsegments as well. So mainly it's with respect to product development or product design and testing and certification. And if you look at the industries which contribute to the spends, you can see that many software companies have the highest they have the highest share in these R&D, in the R&D spends, and because they offshore their R&D bases to India, and to develop software products and platforms. And automotives is the second biggest industry, which they have to do a lot of R&D to improve their products. And the important thing to note here is that the uh, the overall TAM is expected to really jump from $45 billion to roughly 140 to 150 billion in the next by FY30. And we have to wait. I mean, how much of the 130 to 140 billion will be captured by these Indian outsourcing players is a question mark, but at least the overall market itself is growing at a significant pace. Another thing to note on this chart is that the biggest gainer in, say, the contribution to the overall TAM is the semiconductor space. So it is estimated to improve from roughly 9% at current to 12% by FY30. Now let's take a look at the major sectors and what's driving the growth in R&D spends in these sectors as well. So to begin with, auto, which is after software, is the highest R&D spender globally. So you can see that the overall automotive software R&D spend market is expected to grow at a close to a 10% rate till 2030. And if you look at the subsegments, this growth is mainly driven by ADAS and assisted and probably even autonomous driving. We are looking at, I think Waymo. If you've seen the news recently, Waymo is gaining a lot of traction in California, and they're expanding to Austin, Texas. And it's said that Waymo is, the revenues, the ARR of Waymo will be close to $250 million already. Therefore, even if it's not fully autonomous, lot of car manufacturers are providing level 2 and level 3 autonomous driving. So that is also, that is driving growth, and it's growing rapidly. And other parts of the car, which is other parts of the auto segment, which is also growing, is with respect to infotainment and cyber security within these cars. Of course, battery management, electric powertrains, and chassis design are other areas of growth as well. If you actually look at the evolution of the cars or evolution of automotives over the past decade. So if you just take a look at the chart on the left, so it says that, the electronics components or electronic systems as a percentage of the total car cost was only 15 to 20% in 2000, and it is estimated that the electronic components as a percent of the total car cost will go to 50% by 2030. So cars are becoming more smarter, they're also becoming extremely complex because of because of the various features that each automotive major is throwing into these cars to ensure that the car differentiates from each brand. And interestingly, if you look at the chart on the right, as the electronic systems and electronic components become a significant portion of the overall automobile, you can see that the percentage of vehicles which are actually recalled due to electronic component defects have also surged. And in 2019, roughly 50% of vehicle recalls were due to the defects in electronic components. Therefore, it is pretty evident that there is like software is eating the car as well, and these cars are becoming extremely complex, and it is imperative, or it is crucial for these automobile manufacturers to ensure that they get the integration of electronics and into the car perfect, or else they will be facing a lot of vehicle recalls, which is extremely costly for them. And this is data from the US transport regulator. And you can see that over the past 4 years, the number of automobiles which have been remedied by over the air updates has actually has massively jumped by 3 to 4x. Therefore, these issues were actually caused by, say, faulty electronics or faulty software, and they were resolved by over the air updates. And if you think about over the air updates, that was kind of unthinkable. I mean, that was not heard of, say, even 5 to 7 years ago. Therefore, as complexity increases in a car, defects are also bound to increase. So that necessitates spending in R&D to ensure that the cars are defect free. And to this extent, historically, auto companies are not tech companies, right? Therefore, they are not able to in-source or in-house tech talent or software talent. And therefore they are struggling they are struggling with this dilemma. So right now, seamless integration with multiple subsystems in the automotive is extremely important, right? So at present, there are a lot of electronic ECUs, which are most of the ECUs in cars are basically like standardized ECUs. There's no customization for a particular vehicle or for a particular OEM. So for any over-the-air updates and things like that, it will take time and it is extremely cumbersome. So most of the car manufacturers globally, they want to centralize their vehicle controls within one central computer unit, and that will eventually. So this will take time. So right now it is not owned by them, but eventually in 2 phases they want to centralize the vehicle controls within one unit, and that will help them own the IP, and will enable comprehensive over the air updates as well. So they will have more control over development and costs. So they are, but there is one thing to note here is that they will not be able to in-house it completely, because they do not have they are only building the competence now, and it is also hard for them to build the employee workforce internally, and it'll be economical for them to partner with certain certain consulting companies or IT outsourcing companies, like the companies in India. Therefore, there will be a partnership which happens in the future. Another important trend which will probably take place going forward is monetizing of software. Many companies like Tesla, Stellantis, General Motors, and so on, they're projecting that, say, by 2030 or between 2030 and 35, roughly 10% of their revenues will come from software, will come from selling software, and the margins of the software revenues will be at 15-20%. Therefore, they expect they are banking on software revenues to boost their revenues and profitability in the future. Therefore, software is also becoming it's clearly becoming an integral part of an automotive player. And if you take a look at the geography-wise split of the R&D spends globally, interestingly, there is also a differentiation here with respect to traditional IT players, where most of the IT clients, or the biggest market in the world, is the US. But for the automotive R&D space and many of the R&D subsegments, Europe is actually the biggest market, because there are a lot of automotive or automobile companies in Europe. So Europe constitutes to 50% of the overall market, and 80% of this 50%, that is 40% of the overall market, is constituted by just Germany. And even China and Japan are very big markets because of auto companies like Toyota, Honda, and even the Chinese players are also growing rapidly now. Therefore, the market is actually pretty diverse in contrast with traditional IT services markets. Now, let's take a look at aerospace. So, the major trends in aerospace are: one, they want the aerospace players, or the like, say, Boeing and Airbus, they want more fuel efficient aircrafts. They want they want to lightweight their aircrafts, and of course, since the electronic components are also improving a lot, and the cyber security is a key growth driver. And additionally, they're also looking at additive manufacturing to reduce tooling costs. So importantly, this is something Cyient had said in one of their con calls, the management of team of Cyient. And they were broadly, they were saying that uh, the design cycle in aerospace takes place every 10 years. So the design cycle takes place every 10 years, wherein the design of a new program or a new aeroplane design happens every 10-15 years. And the last upgrade cycle actually took place in between 2000, roughly around 2008. Therefore, it is said that the next upgrade cycles could happen anytime between 2025 and 2026. And you can see that the aerospace players who had done really poorly between 2019 to 2022 because of COVID, which curtailed travel. But post that, the order books for Airbus and Boeing are close to all-time highs, and demand for travel has also significantly surged. So it is very likely that we can see a design upcycle, or a super cycle as they call it, maybe, which begins in, say, 26 or 27. It is tough to know when it will start, but it will probably start sometime in the next 3 to 5 years. Therefore, even aerospace is also due for an upcycle. And if you look at, say, plant engineering, which is another subsegment, which is big with and certain Indian companies like L&T Technology and even Cyient have made some acquisitions in this space. And this broadly encompasses, say, plant design, structural design, uh, prototyping, and plants simulation. So the end result basically is for improving yields, reducing operational costs, increasing automation, and ensuring safety as well. And this is also a pretty growing sector, because one, the trend in plant engineering is the big trend in plant engineering is carbon capture at oil and gas companies, and even other companies wherein they have to reduce their emissions due to government regulations and ESG. Therefore, plant engineering focused toward companies can also capture this growth opportunity in, say, carbon capture, and reducing plant emissions and improving automation at these plants to increase efficiencies as well. Now, if you take a look at consumer electronics, so there are the major trends in consumer electronics are, I mean, these in consumer electronics generally, there's constant innovation as each company competes with each other. And right now the trends are, foldable and flexible displays, smarter devices, and wearables. And you can also see, I think, Meta and Snapchat. So Meta's Ray-Ban glasses have been a huge hit globally, and I was reading in the news that recently Meta and Snapchat are going to launch their next generation glasses sometime soon. Therefore, AR VR devices and smart devices are penetrating our lives, and the the growth will only kind of accelerate here onwards. If you just take a look at the overall outlook for all the industries put together, BCG estimates that between 2023 and 2030, the overall market itself will grow at a high single digit rate, close to 10%. So the overall market itself is growing at a 10% rate. So companies within operating in this market can grow at a significantly higher rate if they're able to gain market share. And if you look at the outlook if you look at the sectoral outlook, broadly all sectors are growing at a high single digit rate. But few sectors which stand out are the software sector, which is continuing to grow at a fast rate, and semiconductors, wherein customized chips for specific applications. These ASIC chips are, those kind of opportunities are expected to be really high going forward as well. But roughly all sectors are, expected to grow at a high single digit rate. Now, moving on to particular companies which are listed in India. So, if you take, we spoke about how even tier one players are part of and have a big business in ER&D, but they do not give this breakup of their ER&D revenues in particular, except for HCL Tech. So we'll just take a look at certain other companies who are pure play ER&D players who are listed in India. And I've just taken a few names for examples. To give an example, so you can see that uh, the exposure to certain segments is actually very company specific. So it is not similar to a traditional IT services company, wherein most IT services company are really banking heavy, whereas here it is very company specific. For example, you can see KPIT is only focused on automotives, and whereas L&T Technology has a pretty diversified portfolio, and so does Cyient right now, after they've done a few acquisitions over the past 2 years. Therefore, the mix is very different for different companies, but transportation is pretty much the largest segment for all players. And looking at, say, the revenue growth itself over the past 7 years, just like how just like how the segments were different for different companies, segment exposure was different. Growth rates are also different based on the exposure to different segments, because you can see that there is a lot of divergence in the growth rates, especially if you look at the year on year growth rates for a lot of these companies. Because so you can see that over the past 2 to 3 years, KPIT has really outperformed the other players, and they're growing. They grew at, say, for close to 40-45% over the past few years, and even for FY25, they're guiding for a close to 18 to 20% growth rate. This is because, like we previously spoke, their only exposure is to the automotive segment, and the automotive segment is going through a massive upcycle right now because of the reasons that we spoke about previously with respect to increasing complexity in automobiles. Therefore, the sectoral tailwinds also really help companies in this space. And uh, if you look at the, if you so over the past 3 to 5 years, post COVID, all these companies have really accelerated and have grown at really good rates. However, in FY24, the growth has, barring for KPIT, the growth has really decelerated. And even in FY25, at least in the first quarter and the outlook that they're giving, say Tata Lexi, L&T Technology, Cyient, and even Tata Technology, they're only expected to grow at high single digit to low double digit rate. Therefore, that is because of the diversity in their segments. So, but however, in the future, that can also protect them when the global environment and the spend start reversing in the future. So we can look even pre-COVID. You can see that these companies were growing at a pretty high rate when mid-teens or low teens rate when compared to traditional IT services players. And this is actually a chart showing the differential in growth rates with respect to IT services players over the past 10 to 12 years. And if you look at the data from 2013 onwards, there are only 2 years, that is in FY21 and FY22, where IT services actually grew faster than the ER&D market as a whole. However, even in those 2 years, the players which are listed in India have grown faster than the IT services players. Therefore, this is because of the lower penetration levels in outsourcing ER&D. So they have that tailwind at the back of them, helping them do well. And over the past 10 years, these ER&D players have compounded at the market has grown at say 12.5% over the past 10 years versus high single digits 9 to 10% for the IT outsourcing sector. And if you take a look at the geography mix for these companies, that is also slightly different from traditional IT companies. Therefore, you can see that many of these companies have significant exposure to Europe because there's a lot of automotive and other engineering companies in Europe. Therefore, the European exposure for ER&D companies is pretty high, and the North American exposure is also high, of course, because there are a lot of companies in North America as well. And if you take a look at just the R&D spend. So roughly, of course, this is pretty logical, but 50% of the R&D spends of the global market is contributed by the top 100 companies. Therefore, if you want to scale in ER&D, you need to have clients in the within this top 100 bracket. And of course, since there are a lot of ER&D companies, and there are only 100 to say 200 big players or massive players. Therefore, client concentration will inevitably be high. It will also take time for clients or for companies to gain new clients because the competition is also really high for these 100 to 200 players. So therefore, that is also a big difference in with or a big it's kind of unique to the sector. And with respect to that, if you look at the client concentration levels across a few companies, you can see that one clear or something evident is that the number of large deals, say above 50 million, above 100 or above 100 million, above 500 million, above 1 billion, which we are used to seeing in a large IT or traditional IT companies, is not possible in the ER&D space because all these development projects will probably be broken up into multiple smaller projects, and these multiple and the R&D budget itself for certain projects will not be so high, especially for them to be outsourced. Therefore, the large deals which we see generally is very few and far between, very rare in this sector. There are a lot of small deals, 1 to 5 million deals, or 5 to 10 million deals, which these companies will have to keep keep winning, and they'll have to ensure that the relationship with the client is perfect to gain their wallet share. Therefore, even the tenures of these deals which they win is not really high because of the lower contract size or the lower deal size. But that is uh, that is kind of compensated by the velocity of the deals as well. And if you take a look at the client pyramid, like we just spoken, you can see that the concentration levels are really high. So the top 10 clients roughly contribute to say 40-50% for most companies. And I think in our KPIT, since they are only auto focused, they just have 25-30 customers who contribute to say over 90% of their revenues. Therefore, client concentration will always mostly be high in this sector, except L&T Technology has a slightly more diversified client portfolio. But yeah, client concentration is standard for this industry. And and if you take a look, so this was a slide which was given by Scient in during their investor day. And if you just look at it, their engagement with Pratt and Whitney actually started in 2000, and they've been working with them, and they have been increasing the scope of their work over 20-25 years now. Therefore, customer acquisition takes time, and wallet expansion also takes a lot of time, but the churn in customer will probably be low, especially as the relationship gets built over a long period of time. Therefore, that's how the industry is structured. And moving on to the headcount for the industry as well. Uh, so you can see that the headcount for across companies in this industry has grown at a really strong rate. So Tata Elxsi the 5-year CAGR in the headcount growth for Tata Elxsi is close to 17%. Its headcount growth is close to 14% for KPIT, 10% for L&T, and 5% for Cyient. Therefore, you can see that the year-on-year growth rate is also pretty high for all these companies, which is kind of in line with their revenue growth rates as well. And looking at the structure of their contracts, on the left you can see that you can see the on-site mix. So many of the on-site mix in these ER&D companies is kind of high when compared to other no, traditional players. So it's close to 50%. It's harder to outsource or offshore more than more than a certain point. Therefore, the on-site mix is close to 50% for most of these companies, and close to say. But for Tata Elxsi alone, they have a significant offshoring mix, which is close to 75% is the offshoring mix for Tata Elxsi. And on the right, you can see that those are the fixed price contract mix for these companies. The fixed price contracts are generally better for margins, because you can find certain efficiencies, and which you can these companies can find efficiencies within the company, and they need not pass on those margin improvements to their client. So therefore, you can see that Tata Tech and Tata Elxsi have significantly higher fixed price contracts when compared to the rest. And that is also indicative. You can that is kind of indicative in their margins as well. So Tata Elxsi, which has the highest offshoring mix, also has the highest EBITDA percentage or EBIT margin also. So while everyone's margin is close to between 18 to 20%, Tata Elxsi is close to 30% at the moment. And yeah, actually, companies like KPIT and Scient, which were in the low teens in 2020. So KPIT has done really well, and they have improved their margins over the past 3 to 4 years. Scient will also improve their margins last year, over the last year, but we'll have to wait and see how the margin trajectory is going forward as well. If you just take a look at the per employee metrics, uh, so if you look at the profitability per employee, roughly all of them are close to 9,000, $10,000 per employee in EBITDA in the past year. And Cyient was you can see the efficiency improvement in KPIT and Cyient over the past few years. And of course, every company has actually improved their margin per employee or their efficiency over the past 4 to 5 years. And we have seen the BCG outlook. Even McKinsey is actually projecting that the engineering services division as a whole would probably be compounding at low double-digit rate at between 10 and 12% over the next over the next 3 to 4 years. So broadly, the market is itself expected to grow at a 10 to 11% rate. And therefore these companies in these Indian companies can gain some market share and go at a slightly faster rate, because that's what they've done historically. So uh, it is likely that they will do that in the future as well. So what are the risks broadly in the sector? One, of course, we saw the rise of global capability centers. So they can if once they start gaining a lot of scale, they could probably insource some of their work. But yeah, that will generally they do not have the experience or the bandwidth to grow their workforce in India. And especially for certain projects, they will rather outsource those projects because of cost pressures. And cutback in discretionary spends is, of course, a huge risk, and that's led to the slowdown over the past 12 to 18 months, because these R&D spend. So the R&D is generally done to improve revenues and to improve customer experience, and so it's more of a revenue center. And so they will be the first to be cut when during an economic downturn. So this is actually the R&D spends will be cyclical in line with the business cycle. And of course, and we looked at client concentration. So client concentration is definitely a big risk. um, and some of these clients could also start putting in exclusivity clauses in their contracts, because they would not want a vendor who has access to some of their IP to be working with other vendors as well. Therefore, client concentration will always be a risk in the sector. And so for certain companies, even industry concentration is really high. So they are really geared towards certain industries, and that has actually that has affected them in the past also. So uh, that is something to be monitored. And of course, competition, like every other sector, is pretty high in this industry, and it is even more so because the number of clients or the end users is limited. So the competition for the wallet share of these clients will be very high. Therefore, but therefore, execution and management quality really matters when looking at these companies. So that brings us to an end to the webinar. So we are just taking a look at the product of the product, the TrueBlue product right now. And so uh, let's talk about the to talk about iThought's investing philosophy. We generally have a long-term focus. So we have a more than, say, 5 year outlook, close to 5 years or even beyond outlook when we are investing in companies. We try not to avoid being part of the crowd, and we don't really take any macro calls. We take a bottom-up approach to look at companies individually. And specifically to TrueBlue itself, it's a 100% pure large cap product with a high active share and with low churn. So if you it is if you look at, say, other large cap products in the industry, they are allowed by regulation to invest in small and mid cap funds, I think up to 25% of their fund. Therefore, if you want pure large cap exposure with high risk, high return to risk, then this is the product for you. You can see how we have performed over the past, I think the last few drawdowns, which obviously there have not been significant drawdowns in the Indian market, but the last two drawdowns which happened over the past 2 years, you can see that we have performed much better on the downside compared to other mutual funds. So yeah, we target risk adjusted returns, and we are generally around 200 to 300 basis points above the benchmark returns over the longer term. So product is generally suitable for first-time investors or investors who want to build a retirement corpus, of course, family offices and institutional investors as well. Uh, Moving on to the investment team, of course, it's Mr. Shyam Shekhar is the founder and fund manager, along with Mr. G.R. Balaji, who's the head of research and the co-fund manager for the product. And yeah, this is the product performance over various time periods. Yeah, so if anyone, that brings me to the end of my presentation. So I'm happy to take questions. If anyone has any questions, please, you can type it in the chat box. Yeah, thank you. Thank you for compliment. And I think certain BM is asking why the True Blue performance is lagging the benchmark. So actually, if you look at the performance of the Nifty itself, if you see look at the companies or the drivers of the underlying performance, a lot of the performance has been driven by say certain PSU companies and and companies in a lot of commoditized sectors. But we in True Blue, we do not really invest in public sector companies, and we do not invest in commoditized sectors. Therefore, we have a longer term outlook. So these sectors, while they will do well in the interim, in the shorter term, over the long term, it is pretty evident from data points that you have to stick to companies which generate high returns on capital over, say, a 5 to 10 year time period rather than a 2 to 3 year time period. So that is why I mean, definitely, yeah, that is why there's definitely a lack. But we believe that our portfolio is positioned well over for a longer term investors, because uh, the quality of we generally have a high filter with respect to the quality of the companies we invest in as well. Mr. Anand asks, do you provide mutual fund service? Yes, sir. So I think you can you can get in touch with our representatives, or I'll let me ask our relationship managers to get in touch with you as well. Yeah, I think there's a question that European automotive companies are fearful of investing in R&D due to a shift in due to shift towards EVs with respect to IC vehicles. So actually, that probably is yeah. So they have like if I okay, I got it. So yeah, like you said, they are they are it has become imperative for them to invest in their electric vehicle platform. And in their battery management systems and so on. Because I think recent and they have been investing. I think I just read yesterday that if I remember right, BMW has actually overtaken Tesla in Europe in terms of monthly sales. Therefore, these companies are starting to gain traction and starting to gain confidence in their electric vehicle platform as well, and they are investing for the future. So that is what is driving the shift. So, SR asked, you had mentioned that science management is of the view that they're expecting an upcycle in aerospace, but as per BCG sector, BCG's consensus estimate, growth rate is only estimated to be 7 to 8%. Yeah, so I think uh, I mean probably BCG will be the best people to answer that. But so these are, I mean, when you look at these estimates from say these consultants, they are just one data point, so you should not. And even when you when you look at what management teams say of these companies, you should not take it at face value. So you should just try to look at collect various data points as much as possible. But clearly the timing of the upcycle or the upgrade cycle in aerospace is tough to call out, because even the management teams do not know when it will happen. So and the aerospace companies will they would like to milk the cow, so to speak. So it is tough to say when it will happen, but yeah, we are closer towards the probably the way to look at it is that you are closer towards it happening than it not happening, as in you're past the middle point. So when you will have to keep tracking the sector to understand when it'll happen, but it'll likely happen by in the next 3 to 5 years. Uh, Yeah, I think so. The presentation, the webinar itself will be uploaded on our YouTube channel, that is iThought PMS. On the fee structure, I would request fee structure and other questions that you had asked. I would request you to contact our relationship managers. They would guide you to the appropriate structure. And yeah, and yes, True Blue is a PMS, and the minimum investment amount is mandated by SEBI, which is close to, which is 50 lakhs. So that is the minimum investment amount. Okay. I think if there are no further questions, we can uh, we can end here. So yeah, thank you everybody for your time once again. Thank you for joining us on a Saturday morning. Yeah.